RBI has released a draft guideline on the liquidity risk management frameworks for NBFCs, including core investment companies, in May this year. The circular is aimed at improving governance, regulations, and reporting structures of the NBFCs and strengthen the asset liability management frameworks in the NBFCs. The proposed norms are expected to be adopted from April 2020 by all deposit-taking NBFCs, non-deposit taking NBFCs with an asset size of 100 crore and above, and all core investment companies registered with the RBI. Some of the key highlights of the regulation include a stronger board and management oversight through setting up of asset liability committees, defined policies and procedures, more granular maturity buckets and tolerance limits, and a requirement to measure and monitor a number of metrics including funding concentration, unencumbered assets, early warning indicators, and other metrics. Adoption of a stock approach to liquidity to focus on the short-term borrowing composition of the balance sheet, extension of liquidity risk management principles to monitor off-balance sheet and contingency liabilities, intra-group fund transfers, diversification of funding, collateral position management, stress testing, and contingency funding plans. Introduction of liquidity coverage ratio or LCR for all deposit-taking NBFCs and non-deposit-taking NBFCs with asset size of 5,000 crore and above. LCR ensures that NBFCs have sufficient high-quality liquid assets to survive any acute liquidity stress scenario lasting for 30 days. The regulation is expected to have a positive impact in the sector as the new set of guidelines are close to banking regulations and will address the long-standing concern that the sector is not adequately regulated. In the long run, it will increase transparency and inculcate prudent liquidity management and structural stability in the sector. The regulation will create a new set of investors for the government securities and increase the depth of the bond market. It will dispel the worries of banks regarding liquidity position of NBFCs and continuation of fund flows. The various public disclosures on a regular basis will boost the investor confidence in the sector and help them make informed decisions. However, there are certain challenges for NBFCs in adopting these regulations. Currently, the sector growth is already muted due to liquidity tightening, and so the immediate challenge for NBFCs in the short term is to tide over the prevailing situation. The profitability margins are expected to be hit due to negative cost of carry associated with liquidity positions, which may translate into higher lending rates and fees. But given the intense competition in the market, NBFCs may face challenges passing on the cost to their customers. The regulations may also force consolidation in the sector where smaller NBFCs may find it difficult to comply with the regulations. Aptivaa has helped many of its clients in various geographies to help establish robust liquidity risk management frameworks and provide tools to adequately measure and monitor liquidity risk metrics.